For years, policymakers in governments, central banks and academia has preached easy money and inflation as a solution to the economic woes in Europe, the United States and Japan. But years of administrating this medicine have had no effect on growth. Instead, it had led to asset bubble. A short cycle decline would not be such a problem, but this appears to be a structural policy combined with the inflation targets. Another comment by Prince Michel from March 5, 2016 reminds us that certain solutions all over the world didn't bring the intended effects. For years, policymakers in governments, central bank and academia have preached easy money and inflation as a solution to the economic woes in Europe, the United States and Japan. But years of administrating this medicine have had no effect on growth. Instead, it has led to an asset bubble, damaged savings, especially retirement funds, and motivated governments to delay painful but necessary reforms. In July 2017, Prince Michel continued to point out how irresponsible policymakers were implementing dangerous solutions. President of the European Central Bank Mario Draghi has also changed his policy. Instead of seeing the lack of inflation as the main case of insufficient growth, he has begun blaming inequality as the root of the problem. This is very confusing. First, the flood of cheap money, but heavily inflating asset prices. The influx of cheap money has used to buy shares, companies and real estate. This delayed case increased price and valuations. An economy that grows mainly due to abundant cheap money is a bit like a drug addict. Nevertheless, the ESB continued to lament the lack of inflation. Prices of company shares and real estate skyrocketed artificially and on paper, causing a larger concentration of wealth with fewer people. The low and, in some cases, negative interest rates also hit people with saving in banks. This inequality was readily caused by central banks' policies, as this bubble is bound to burst eventually. A leveling off will take place, but at a very high cost. Cheap money today, a disaster tomorrow. A year later, the global situation seems to have reached a tipping point, but again, the main action were surprised by the consequences of the solution they had implemented. Moreover, they were interested in treating the symptoms and not the root cases. In July 2018 comment, Prince Michel concluded, "The growth in recent years has been largely driven by consumption. Unfortunately, this was non-negligible extent due to abundant consumer and housing credit based on cheap money provided by the central bank in nearly all major economies. At the same time, most governments didn't take the opportunity to reduce their deficits, but continued high level of spending and increased their country's debts. All major central banks arrived at the limit of their ability to reduce interest rates, being already near zero or below, and have begun to take off tapering. The US Federal Reserve has already started while the European Central Bank announced its more than 2.6 trillion euro bond buying program was end in September. Believing in the magic that some 2% inflation enhanced growth, the officials at the ESB have concluded that this goal has finally been reached, so they can also slowly increase interest rate. However, there are two problems. First, even if we believe in the 2% magic, this figure is mainly driven by an increase of 8% in energy prices and some 3% in food prices. Significantly, core inflation rose by just 1%. But what really aggravates the situation in this? An economy that grows mainly due to abundant, cheap money is a bit like a drug addict. It cannot function without an additional money supply. It always needs more, or else it collapses. A short cycled decline would not be such a problem, but this appears to be a structural policy combined with the inflation target. Another comment by Prince Michel from March 5, 2016 reminds us that certain solutions pushed by policymakers all over the world didn't bring the intended effects. For years, policymakers in the governments, central banks and academia has preached easy money and inflation as a solution to the economic woes in Europe, the United States and Japan. But years of administrating this medicine have had no effect on growth. Instead, it had led to asset bubble, damaged savings, especially retirement funds, and motivated government to delay painful but necessary reform.